All right, let's get into another one. This one, we're going to focus on stochastic RSI and the awesome oscillator. Um, Overview of what these indicators are, how I use them. As always, not financial advice. I'm not a licensed financial advisor. This course is for education purposes only. So we'll start off with a stochastic RSI. As the name suggests, this is a derivative of RSI. RSI is probably the most popular. Definitely the most popular momentum indicator, if not the most popular indicator that just pops up and you see in the technical analysis trading view guru world. Stochastic RSI, I became a fan of over time, just because I think it's a little bit more straightforward and potentially more useful. So it contains the information that a lot of times is pertinent from RSI. But then the kicker is it also compares that to RSI over recent period range. So if a momentum indicator is a comparison of price versus the recent period of price, so, are we stronger? Are we weaker than recent conditions and what has come before us? The stochastic RSI is like one step beyond that because it's momentum is, how does price compare to how price has been recently? This is how does momentum compare to how momentum has been recently? So like a one level of momentum inception further than just using RSI. It's a momentum indicator. Uh, Pros, it tends to be sensitive. It shows you a lot of information, reacts to price changes quickly. It gives you a lot of signals, which accounts to a lot of potential trades. So really the name of the game is, filtering out potential trades that it gives you to take to taking the best ones and the ones that are most likely to work. So if you use stochastic RSI as a signal for taking trades, you'll have a lot of trades to take and you won't have any lacking in terms of opportunities there. Uh, just you may have too many to track and they may not all be the highest possible quality. The cons are more or less the flip side of the pros. Because it's sensitive and reacts and gives you a lot of information, sometimes price just won't line up with what the stochastic indicator is telling you. So it may tell you that it's a great time to get in a long, but price just doesn't pump very much because it's not in a mood, a very pumpy mood. Sometimes conditions are just choppy, and momentum doesn't end up having that follow through in the price action. That's just part of the game. Every signal can't be perfect and every market condition can't be perfect to trade. As I mentioned, it can just be overwhelming, kind of be noisy and give too many signals, especially in conditions that are very volatile, where it's already a pretty sensitive instrument. It can just get blown out, just like, blast and stick in one of the upper or lower bounds and just stay there and give like a ton of crosses before it does anything. And that's the downside and why it's not the only thing that I use as part of a system. The second indicator, the awesome oscillator, um, it's a funny name. It lives up to the name. It's awesome. It uses two simple moving averages, and what is plotted is like the area between the moving averages and a zero value. There's a slow moving average and a fast one, and the difference between these um, gives the visual. It's much easier to understand visually, so whenever we hop over to the chart, that side of things will make more sense. The pros of the awesome oscillator are kind of the other side of the coin compared to a stochastic RSI, where it's slower, the accuracy is higher, it's very simple and clean. It has a strong reliability for showing if conditions are bullish or bearish. So the stochastic RSI spends its life cycle just bouncing in between the upper and lower bounds. Um, and we'll do that regardless of how the overlying conditions are. The awesome oscillator, like if conditions are bullish, it'll go up. If conditions are bearish, it'll go down. And it will show that very clearly and cleanly, which is very useful and why it represents another useful metric for viewing momentum. I think the combination, especially of these two indicators, is very powerful, and why they are the ones that I built my system around. The cons are in line again with the pros, where it's slow compared to other momentum indicators. So it may show you that it's a good time to take a long, but price has already moved up significantly, so you're lacking the like very dialed in sniper entry you might have been able to get using other indicators and other metrics. And because it's slower, it will give you fewer trade opportunities because a lot of the noise in the stochastic RSI is filtered out from the AO side. Spoiler, we use both of these together, so the goal is we amplify the pros and minimize the cons by combining the two of these. And that's kind of the nuts and bolts and the little bit of magic that happens behind the system, which I really enjoy trading, if that wasn't apparent by getting excited talking about these momentum indicators. So let's hop over to the chart and see what I'm talking about visually. Both of these make a lot of sense visually, I have found. Which again, we're not robots. We're not just analyzing data. We are looking at pictures, which are representations of that data, and allow us to, synthesize stuff much faster than if this was just numbers on a screen. So we'll look at the stochastic RSI first. That's this guy down here. Like I said, stochastic, the name of the game is spending its life cycle in rotations between the upper and lower bounds. The overbought area is the upper and oversold is the bottom. The core thesis with the use of the stochastic RSI is um, that it, in fact, spends its life doing these rotations. And if we're in the lower bounds, if we are oversold, we're going to get back to overbought. And that's a 100% chance we will always get back there. And we are, by taking a trade when price is oversold, we are betting that the time that we are entering it is the time that that rotation is going to play out. We're putting some amount of risk on the table, and if successful, we'll capture the rotation and price will back up what we're doing, and it will mirror what the momentum indicator is telling us what will happen. If we're not successful, the momentum indicator will do its thing and do the rotation, but price will just kind of fall through. Um, Kind of a con area you can see here. So this was a trade taken on a higher time frame. So um, based on the 64 range chart, which we're on right now, we had a low area here. We pumped up a lot. Stochastic was already overbought at this stage, which was the very beginning of the pump. So too much reactivity based on this movement. Um, Hunting for shorts in here would not have worked well. And we continued to go up and continued to hit that overbought area before the rotation went down. So we spent a long time kind of just being blown out where there wasn't really anything meaningful going here on here until eventually we did get the cross and the rotation down, which would have represented a valid trade, but there were a few false signals to get there. And then after that happened, we just went back down immediately into the oversold area. So this is an example of a time when conditions were just too volatile to where stochastics were just throwing out, too many signals. In terms of the nuts and bolts, the stochastic is two lines, two moving averages. For all intents and purposes, the way I have mine set up, the white is the faster one and the blue is the slower one. And that's about all you need to know. Whenever the white crosses over the blue positively, that's a sign that we're getting bullish. Because the white one moves faster. If the white starts moving up, that's a sign that the blue will follow, and we may be getting that rotation back to the bound on the other side. So every time a rotation happens, it's preceded by a cross. of the white line in that direction crossing over and going there before the blue line does. In my custom settings, I have it customized to where it prints an arrow. So some number of the arrows that it prints represents good trades. Um, some represent poor trades. Really, the system refinement is taking the good trades and missing as many of the poor ones as possible. You can see during this pump, we did form a high and we did get a cross down right here, which you could have entered a short on and had, a very tight stop and had a very nice play out. And that's the like that good signal that the stochastic RSI gives you. In ideal conditions, you will have fewer false signals. In this one, it took one, two, three, four, five red cross arrows. So times that the white line crossed the blue line and acted like it was going to do the rotation back down to the other side. So it took five of those before the trade actually played out. In practice, we can usually hit a lot better than five. And there are other reasons why you wouldn't have just been shorting here, but based purely on the stochastics, that's the thought process and the information and what we incorporate into our trades. The awesome oscillator. Comparing the two, it's a lot cleaner. It's just a histogram, which is an area between where the moving averages are and a zero line. And the further the histogram is away from zero, whether that's on the negative side or the positive side, the stronger the trend is. So zooming out a little bit, like we can see that the absolute value we got to here was pretty high. 40, 42, something like that. So we can tell that this recent pump was a very strong bullish momentum. So that's one use, just how far away from zero we are getting. We can see that things were pretty bullish. Another use is flipping in the color of the histogram. So I have mine set so blue is the bearish color. So whenever it's moving down, it'll be blue, and then it'll flip to white, and it'll go back up. It'll cross over zero, and it'll go into the positive. So if you were only using the awesome oscillator to take trade signals, you could enter longs every time price is negative and flips to a bullish bar. So the bullish bar prints, in my case, it's the white bar. You enter a long. Um, you wouldn't necessarily be positive in the long run doing this, but this is a signal that it affords and could be a way to trade. Other points, which I use less but can also be helpful, are zero crosses. So we'll get the flip from the bearish to bullish bars. Then the AO will rise and eventually it'll cross zero. Crossing zero can kind of be seen as the midpoint of whatever that move is. So we go from negative to zero to some amount of positive. And crossing zero is a sign that we're moving into the positive and can be a sign that price is going to continue in that direction. So based on just using that as a signal, very handily, my indicator is customized to where it prints a little orange circle when we have the zero crosses. So this bar here could have printed as a zero cross, and you could have entered along here and captured the rest of this move. Obviously, there's a little bit cut off from, when we could have gotten on the very bottom based on the bar color change down here. But also, there are a lot of instances where there are multiple bar changes before anything actually plays out. So taking trades on the zero cross can be more reliable, if, less ambitious perhaps. So that's the basics. I'll go more into exactly how I trade. But that is the overview of the two indicators, which is um, pretty much the secondary level after the range chart in terms of what I do. So it's like price on the range chart and then what the momentum indicators tell me, putting the two of those together. That's the basis of the trading system. So it's pretty integral to have an understanding of the momentum indicators. I guess the other thing to go over is just the combination of the two. So like I said earlier, you can see this stochastic pretty noisy and pretty reactive. So, we got a cross right here and then right here, um, which could have represented long opportunities and a sign that prices may be going to start moving bullishly again. On the AO, we didn't get one until a little bit later. So the stochastics just gave us warning beforehand sooner. In this case, too soon, just because price was pretty volatile. So the AO was like a more accurate picture. And kind of being able to juggle between, am I reading the stochastics right now, trading based on that, or am I giving the AO more weight? That's a little bit more of the nuance in the higher levels. In general, AO tends to be the slower, more reliable of the two. And stochastics are faster and give you faster signals and in the right conditions can just let you get in more trades. Um, the artistry is just making sure you don't get in the wrong trades by trading more. I'm going to cut stuff off from there. Hopefully this was useful, and I'll see you in the next one.